Are you considering investing in commercial real estate but don't have any cash to spare, or are maybe intimidated by the bigger price points? In this video, we will explore a few options that you may have to get around that. I'm Tyler Cauble. I'm a commercial real estate broker, developer, and investor, and I'm here with BiggerPockets sharing some commercial real estate investing tips and strategies based on my 9 years in the industry. You can find me on Instagram at Commercial in Nashville, and don't forget to like, comment, and subscribe so that BiggerPockets can keep bringing you awesome real estate content just like this. So today, as I said, we will cover investment options with no money down. And then I'm going to share some investment methods that require little money out of your pocket. A quick caveat, these strategies are not the easiest to pull off, but they are entirely possible, and I've actually used a few of them myself. In fact, it's how I was able to buy my first office building when I was 26. I definitely didn't have the funds to do it on my own, so I had to get creative. Now for those investment options with no money down, which are rent to own, seller financing, seller crediting a down payment, SBA 7A loans or owner-occupied real estate, and subject to acquisitions. Investing with no money down may not be the easiest or even the most convenient, but no money down methods can be excellent ways to begin building your portfolio before you have money to invest. First, rent to own. Starting off with a lease on a property prior to purchasing it can actually be beneficial for both you and the seller. Leasing will give you a chance to test the waters to make sure that the building and the location will be right for you while decreasing your overall risk exposure. The seller will also be collecting rent each month, which most landlords won't be upset about. Here's an example of how you could approach a rent to own scenario. First, decide upon an appropriate monthly rent rate and any tenant improvements just as if you were negotiating a normal commercial lease. Then, pre-negotiate with the landlord how much of the rent will apply towards the purchase price when you do decide to exercise a purchase option and what that purchase price will be. Next, you'll set a timeline as to when you can exercise that purchase option, which is typically in a 3 to 7 year time period, but that's completely up to you to negotiate. If at the end of that window you decide not to purchase the property, all you've done is lease the space. However, if you do decide to move forward and purchase the site, the seller will typically credit you those rent payments at closing, whatever you pre-negotiated on the front end, which could of course apply towards your down payment. You don't have to own a business that would be operating within the space either to make this method work, although that could be an option if you do have business holdings. You could essentially arbitrage the lease by negotiating with the seller for a sublease clause where you go out and find a tenant to occupy the space at a higher rate than you are paying the landlord. If you have any issues finding a local bank or lender to loan you the money at the acquisition, you might be able to use the next method of seller financing in combination with rent to own. So now for seller financing. Seller financing is exactly what it sounds like. The seller, instead of a bank, will finance your acquisition of the property. Essentially, they'll hold the note on the property and retain the mortgage while you make payments to them. Seller financing is a good option for buyers with credit issues as well, because sellers often won't perform the extensive background and credit checks like a traditional lender would. Keep in mind that while you may not necessarily be paying out of pocket for a down payment, you'll likely have to pay above market interest rates or agree upon a higher purchase price to make the seller comfortable with a 0% down payment. However, if seller financing does help you acquire the property, just might be worth it. Seller financing also provides some tax benefits to the seller since they won't immediately take a tax hit at the sale. Now here's a tip. When pitching this offer to a seller, highlight the fact that they will retain that first position mortgage on the property, so they could always foreclose on you and take the property back if necessary. Hopefully that's a worst case scenario, but it could help you make the seller comfortable with this process. When I first started working in the business, the developer I worked with had owned one building 5 times. He bought it, seller financed it, and the buyers kept defaulting, so he kept taking the property back. Now for a moment on refinancing. Projects with seller financing will often have a 5 to 7 year balloon, which means the loan will come due and need to be paid in full. At this point, you'll simply refinance the property to pay them off. You could also refinance the property at any time before that balloon payment to find better terms with a traditional lender if you've built up enough equity in the property. Now, if you would like to keep your monthly payments as low as possible, I recommend trying to negotiate a 30-year amortization. Keep in mind that you won't have as much equity built up in the property when you go to refinance as you would if you did a 20 or 25-year amortization, but it could keep your cash flow higher than a traditional loan since 30-year amortizations are hard to come by. Up next, we have seller crediting the down payment. This acquisition method is one of my favorites and certainly among the most creative, but you must be very careful with how you approach a seller crediting the down payment scenario. I've only ever seen this strategy successfully utilized one time because of the intricacies involved. First, be upfront with your lenders. You'll want to disclose this strategy to your lender so that they are aware of how the down payment is being paid. Many lenders often won't like that you, as the buyer, aren't the one coming out of pocket for that equity portion. However, I have found that some lenders may be willing to work with you in this case, especially if you have a strong pre-existing relationship or if the value of the property is relatively high compared to the total loan. Next, you'll need to show the seller the benefits of the transaction. When working with the seller, you'll have to show them how helping you with the down payment is beneficial to them. What I typically see is that the overall purchase price is raised to cover this cost so that the seller doesn't have to necessarily come out of pocket to help you. If necessary, you can raise the price a bit more so that the seller ends up profiting more, therefore incentivizing them to work with you because doing so is obviously more complicated than a traditional sale. Now, one thing to be aware of when increasing that acquisition price is that the property will still have to appraise for a lender to feel comfortable giving you the capital to take it down. Depending on the current state of the property, this assistance could also be categorized as a repair allowance and credited to you at closing for making necessary repairs and maintenance to the building. I've also seen buyers negotiate this credit to be an equity contribution from the seller that is structured as a forgivable loan. Transparency with all parties is crucial here so that you don't find yourself in a legal bind. Next, we have the SBA 7A loan. I like to think of this one as the commercial version of house hacking. If you own a small business, the SBA 7A loan may be the best path for you to take. Certain lenders offer financing for up to 100% of the loan for qualifying business owners. Reach out to the top local SBA lenders in your area to see if this program is within their company initiatives. Businesses that could potentially qualify for this loan program must have a significant amount of collateral, a debt service coverage ratio of 1.25 times or higher, a track record of positive cash flow and stability, 51% occupancy of the property or higher, and of course, outstanding personal and business credit. There's definitely a catch here. If you take this loan, your business will have to occupy the majority of the property to qualify. However, you could use the SBA 7A loan to get started and then eventually refinance the property once you have built up enough equity and then transition it into a full-time investment. Now for subject to acquisitions. Notice that some of these strategies are identical to methods you may have used when acquiring residential investments. Buying properties subject to is an excellent way to help out a distressed seller while moving quickly on an investment. Subject to acquisitions became very popular during the Great Recession when property owners just wanted relief from the expenses of owning and maintaining the site. If a seller is in a bind and needs to move quickly, you may be able to purchase their site subject to the existing mortgage, which essentially means that you're assuming their bank note and taking on the liability and expenses that come with it. Again, you'll have to find a very specific seller that is likely in dire straits and simply wants to walk away from the property. This may be difficult depending on the state of the market. Be sure to check with the lender and read the loan documents to make sure that the loan is assumable. If it isn't, then the note could be called as soon as the deed is transferred to you, which could put both you and the seller in a bad position. Now, let's cover some investment options with little money down. As I said in the beginning, the no money down methods can be tough to pull off and typically require investors to meet atypical criteria, so the little money down options I'll explain here may be easier to approach. These methods include obtaining your real estate license, bringing an opportunity to investors, and buying a vacant property and leasing it prior to closing. So first, get your real estate license. Having my real estate license was the best way for me to start buying commercial properties before I had any money. There are certainly pros and cons to having your real estate license, but your ability to negotiate a commission on the purchase of a building is very high on that pros list. The first office building that I acquired actually started out as an investment for a client of mine. My client planned to buy it and move their company into the space, but when financing fell through, I had them assign the purchase and sale agreement to me. I then approached two investors, pitched them on my plans for the property, and asked them for $50,000 each. I rolled in my 3% commission, which translated to 15% equity in the project based on our down payment, and then took another 10% equity for finding the investment and managing the asset. By having my real estate license, I've acquired many more properties using this strategy and having little to no money, technically, out of pocket. Next, bring the opportunity to investors. If you don't have cash, but you know people that do, you could bring them in on your deals. Investors like to get a return on their money and need opportunities to do that. If you can put the sweat equity into a project by finding the deal, putting the plans together, and more, then investors may be willing to place their money with you. If you don't want to come out of pocket for any expenses, you'll likely be giving the lion's share of equity to the investors, but that could still be advantageous for you since it gets you involved in the deal and you'll start building your track record. Similar to my previous method of getting your real estate license, you could set aside a portion of the equity for yourself for finding the deal and putting the whole thing together. And last but not least, buy a vacant property and lease it prior to closing. I used this method to acquire a retail property here in East Nashville. We put the building under contract while it was vacant, and our local lending partners were expecting a 20 to 25% down payment due to the risk of no income. However, while it was under contract, my brokerage team and I worked to find a tenant for the building and ended up getting a lease executed prior to closing, which then allowed the lenders to value the property based on the income from the lease and not just the attributes of the property. We were able to secure financing with a 90% loan to cost due to the high appraisal, which meant that we came out of pocket less than half of what we were anticipating going into the deal. Now, these methods that I've detailed show that it is entirely possible to invest in real estate without having a ton of extra money on hand. You just need to be a little creative. The best real estate deals you'll ever find will often come when you're thinking creatively. I hope this video provided you with helpful information that will assist you in getting started investing in commercial real estate. And if you're interested in learning more, hit that like button, subscribe to BiggerPockets, and stay tuned for more commercial videos.